Okay, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It is November the 6th. Great to have three of our regular commentators here with me this morning. Amar Najia, Global Head of Derivatives at BB Energy, Mike McClone, Senior Macro Strategist at Bloomberg Intelligence, and Bora Barryman, Managing Partner at Hormuz Straits Partnerships. Thanks, guys, for joining us this morning, Monday, start of November. The first Monday of November, a couple of months to go to the end of the year. Mike, let me start with you this morning on what your sort of sentiment is for markets, for oil markets. We just have a graph up there, which is one of the survey questions we put earlier this year. This whole question of risk premium that's being placed, which has been relatively limited, let's say, in the last month or so. So that's a couple of the questions we've put to our audience last week. What direction? We've dropped now into the mid 80s, right? Having almost at 100 more than a month ago. That's going the way you want it to go. But where do you think this market is headed by the end of the year now, if all remains the same with this Mideast conflict and we don't see physical escalation?
So I don't know if it's where I want it to go. It's where I expect it to go because I'm not a trader anymore, which is kind of good, keeps me unbiased. But I think the middle option is the overwhelming option. We are tilting towards a global recession. Now, we clearly have declining economic growth in Europe. The significance of China is still having decent amount of demand for crude oil, might because they're just refilling most of their commodity stocks, not just crude oil. And the U.S. is clearly heading towards a recession. But what's notable and the point is, the significance is we've had the most significant amount of central bank tightening almost ever. And those days, the effects of those tightenings are still early days. So let's look at the key facts in the U.S. as far as demand. First of all, supply is at all-time high. Most people didn't expect that. That's just been a normal trend for 15 years. And demand's declining, most notably in the U.S. The key thing I like to point out, in the U.S., we are clearly heading towards a contraction, yet the market doesn't believe it yet, not the stock market. So to me, that's the next big shoe to drop. Now, the bond market has, because it sees that we're heading there. But if you look at U.S. unleaded gas demand, it's down about 5% before COVID. You look at natural gas demand, it's down to the lowest level since 2017. Yeah. Diesel demand is declining about the same pace in the U.S. as it was during the great financial crisis. And then also another thing I like to throw in there, container board demand, boxes, corrugated boxes, that's down at the same pace as the 2008-9 recession. So in this country, we're clearly heading there on a global pace. We're heading there. And it seems like from a macro standpoint, the effects of the rate hikes are not even being felt. So early days, and I think the market's starting to pick up on this, and the bond market finally picked that up. So I'll end with this. I think the key thing that happened in the last few weeks, certainly at the end of September, is the WTI crude oil probably peaked around 95, and the U.S. 10-year note recently just peaked around 5%.
Okay, thanks, Mike. Amar, let me go to you with that. You've been a bit more sort of medium-term bullish in terms of we're going to go much higher into next year with prices. I mean, this sort of recession argument for the U.S. economy and certainly for Europe, is gaining a bit of momentum, i.e. next year we're going to see something that we didn't see this year, okay? And there's no doubt there's plentiful physical supply out there. So why would you remain, bullish in that circumstance?
Okay, so basically, I take the completely opposite view. I think high WTI. I think 10-year notes go above 5%. I think S&P rallies, and basically, there was a guy who once told me basically that in markets, as long as the music is playing, you've got to get up and dance, right? It's not the time now. The music is playing. It's not the time to kind of say, you know what, it's going to come and, the numbers are bad and all this kind of stuff, because the rate cuts have happened. All the stuff has happened now. Basically, it reminds me of Borrell when they did the sanctions against Russia. That, now that we've put in these massive sanctions, all that we need is basically strategic patience, and it's going to happen. So I think what I'm trying to say is this time is not like it was basically before. So I'm not a fan of all these kind of metrics that worked in the past because of a lot of stuff basically to do with COVID and how much money was printed and all that kind of stuff. So I think basically, I mean, if you look really long term, when the music stops, then I agree completely with Mike. We're heading off a cliff and that's it. But I really don't think that that's happening anytime soon. Anytime soon to me means like, 3 to 6 months. Further forwards, who knows? But it will eventually get to what Mike is saying. But I think it needs to, we need to have we need to have things go even more kind of parabolic and even a bigger crescendo. We need to have the equity markets, the S&P, go above 5,000. We need to have WTI set new highs above that, 95 or whatever it set. We need to see Bitcoin get to, new highs, all this kind of stuff. So I'm not a fan of everything is doom and gloom. We're all headed downwards and all this kind of stuff. I think there's still a lot of market has legs. Basically, is my point of view.
Okay, Bora. I mean, would you generally agree with that, given what we've seen this year, the indications from China of what's happened with its economy in terms of demand there and what's to come next year, and now that the interest rate story seems to be winding down, if you like, maybe that is more positive for demand next year than people have been saying.
Yes, last week's dramatic response in interest rates, outlook for interest rates, bond prices, stock prices, in response to the Fed meeting, for me, is fundamentally an indication that the market conditions will continue to be marked by volatility. Swinging expectations to that degree that pivot on quite nuanced impulses don't indicate to me that there's a solid direction that the market can sustainably move in line with. So in the short term, there's a market consensus. There's sort of I would call it a kind of a bullish trend that the Fed is done increasing rates, but I wouldn't be so sure. Whatever the Fed does in the financial world, in the real world, especially in the USA, there's a huge kind of fiscal stimulus. The US continues to spend more than it brings in taxes, right? And it will continue to do that for the war machine and for the energy transition machine. And this is a very big stimulating factor, which creates bigger deficits that in the long term will reinforce inflationary pressure. So what I'm saying is there's this yin and yang. The inflationary pressure is kind of ultimately leaning toward a tightening policy, but today we see kind of some weakness that that makes the market believe there are no more interest rates rises to be expected in the near term. But again, then the governments keep spending money.
Yeah, so that's kind of counterintuitive and counterproductive, let's say. Mike, let's just talk a bit about, we haven't had you on since we saw the news, a couple of these mergers and acquisitions in the US in terms of the Hess deal and the Pioneer Exxon deal, I believe, the Chevron Hess. What does that make a difference to our expectations on what we're going to see in terms of production coming out of the US, this consolidation? Does it mean we're going to go above 13 million soon and continue going above that? What's the indicator there?
We're going to continue going above it as long as prices stay high. That's been the trend for a decade. It was what I really learned in the book, The Domino Effect. Benjamin Disraeli, I think. Who wrote that book? Brazil was his last name. And it's a key fact. Right now, the average cost of production in this country is around $62 a barrel based on data in the terminal. And there's just too much money to be made. But let's remember, more than half the production is from independent oil companies. And if you include Canada in there, the excess of supply over demand in the US and liquid fuels, including petroleum, things like ethanol, I'm from a farm background, is almost 6 million barrels a day next year. So something's got to stop that. What's typically stopped that is lower prices. So from this continent standpoint, there's a massive excess of supply over demand, and the SPR is not really needed anymore. But you have to anticipate something different from the last decade. Otherwise, that was a paradigm shift that pressured prices, and I think it's going to continue. But the point is, significant in history. Every time we've had pumps in crude oil, the velocity we've had last year on a 2-year basis was the highest ever. We've always had recessions begin within a year afterwards. And every time we've had rates hike this much, and every time we've had inverted curves is what we had a recession. So Bloomberg Economics expects that to start by year end. I'm seeing a recession in all the sources of demand for petroleum, natural gas, container board, all that. And to me, it's not so much a matter of time, but the big shoe to drop, like Elmar's mentioned, is the stock market. And right now, we have to remember the number one factor for all markets is liquidity. And the Fed still has his finger on the tightening button. Now, markets expect by next year, around this time, they're going to be cutting almost 75 basis points. I don't think there's only one way for that to make for that to happen, and that is for the stock market to go down, unfortunately. And then there's also that very high correlation. So that's one thing where the market's been wrong all year. Every day that goes by, it expects the Fed's going to be easing within a year, and it hasn't. So that to me is the key thing to remember here is don't fight the Fed. And the Fed is still vigilant against inflation. So to get that liquidity to be turned back on, to get stocks to go up, to get economy to expand is just not there. They're still fighting, and inflation still double their target.
Okay, thanks, Mike. Omar, let's talk a bit about products and where those are sort of headed. I mean, diesel obviously being a big manufacturing product, if you like, and the influence of what Russia has been doing also in terms of its exports of that. What's changed in the last couple of weeks, if anything? What's the outlook for the end of this year and first quarter as we go into that in terms of spreads and strengths of various products?
I think basically right now the market needs to, I mean, it's trading about 80, let's call it $81. WTI needs to get down to maybe something like 77, maybe 78, something like that before a new basically push up happens. I think basically, so there is a view that says that the US running, an 8.5% deficit in terms of GDP is absolutely massively inflationary. So the US is going to decide, like a lot of governments, whether they cut taxes, they increase taxes, and whether they cut spending, or don't cut spending, don't increase taxes, but basically let inflation run hot and print more dollars. That's what I think is going to happen, because basically politicians, want the easy option. They want to get reelected, blah, blah, blah. What they should do is cut spending. What they should do is increase taxes, but they're not going to do that. So it seems to me to be the easy way. And in the US right now, you have this thing where, they believe that, nothing's going to hurt them, greatest country, I don't know what, blah, 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 blah. So it just seems to be like the natural kind of progression, which is basically they just print, they just cut, and basically you see everything running not just red hot, but white hot. And then we see what happens. But I think also, but anyway, so I think that what we're looking at is more inflation. So what we're looking at basically is higher prices, and that'll be positive for diesel demand. OPEC is still will still, protect the price by cutting or doing whatever they can strategically. For them, it's a matter of survival, because the world is still saying that in, 10 years, 17.5, whatever it is, that we're going to basically, cut you off completely. So I think basically prices head higher. I can't see a single thing where I think basically, that thing is basically gonna go lower in price. I mean, I just see there's way too much money, and there's way too much inflation, and this inflation that they look at, they take out energy prices, and they take out food prices, and they take out like college tuition. I mean, in what world is it that inflation in the US is whatever it is? There's no way. I mean, it's way too high.
Much higher than it actually even the figure they're telling us. Okay.
Yeah.
Bora, I mean, on that front, just OPEC, Amar mentioned OPEC. We had there's a bulletin headline there saying that yesterday Saudi and Russia to continue their voluntary cuts. That's not a surprise till the end of the year. That was definitely expected. And in fact, what's expected is that they will continue with those through well into next year. unless we see something else develop on the pricing front that hasn't materialized yet. Would that be your sentiment, that they're going to be defending the minimum of 80 no matter what it takes?
Well, again, I listen to what they say, and they claim not to be targeting a specific price. But I could defend that position of maintaining the supply cuts, given the news that we had in our morning digest from the U.S. manufacturers, that there's been a fall in business activity, that actual demand for diesel is down in the U.S. And that's contradictory to this kind of the bullish top line economic growth numbers. But when you think about it, with this level of interest rates, with many decent companies not able to access capital in the single digit range, as you will see if you've been in the market, there's going to be a turn down in the real world of making things and moving things, and hence that supports the position of OPEC. And what's driving the market sort of hotter are these fiscal stimuluses. I agree with.
What about China, Bora? What about China? Let's get into that while we have you. In terms of fiscal stimulus, in terms of sort of economic stimulus, it's held back. It hasn't could have gone full throttle in terms of the stimulus programs it's been saying it's trying to do to get consumer spending back. To try and compensate for the critical crises in its economy, such as real estate, etc. Bad banks. Should we expect to see a more aggressive stimulus measures from China next year, and so that's going to impact demand?
I'm not a China expert, but in a way, I don't expect China to do things full throttle. It's a very managed economy, and they go to a certain target. They try to hone the result to a predetermined target, and I think they're okay with meticulously or assiduously working out the kinks in their system. And there are some very big kinks and knots in their system, especially in the real estate sector. But they don't want to create any impression that there's any kind of emergency measure being taken. I think, and I wouldn't want to see any more from them, because that emergency messenger of the lockdown shook the world and changed all our lives forever. But I think, decent middle single digit growth for them is fine. And yes, there are some political pressures that we don't really see, but they're not operating under the same system as these Western politicians, who constantly have to have something, bubbly coming out, and some new initiative to kind of shape their perception by the people. So I would expect more of the same in China.
Yeah. Okay. Mike, let's talk a bit about gas. We have a bulletin that talks about China's reluctance to sort of tie itself to long-term US gas, which, that's more of a, I suppose, geopolitical trade stuff. But, let's talk about spot LNG. And China obviously hasn't said it's not going to stop buying spot LNG from anyone. And link that to Europe's gas situation as we go into winter. And its storage, which is looking quite healthy at the moment. Do you see any pressure between Europe and Asia on that demand for gas this winter?
It seems a little bit like deja vu all over again. You mentioned about high storage, which not underestimate human ingenuity when pressed in need be. And I think that's just going to continue the trade that happened last year. One thing that a lot of people forgot last year when they did all the fear mongering about a cold winter is, yes, we do have global warming in the winter too. Now, so basically the market has to depend on a colder than normal winter and usage more than necessary, despite the fact that trend's been the opposite and everybody's been thrifting. So, and they're finding many ways to create, to bring on more supply every day. So that's the macro. I look at gas more in terms of the US because it's easier for me to measure. And last year we had that spike to 10. and back down to 2. 2 was first traded in 1990. So from what Omar mentioned, when you look at commodities, particularly from my standpoint, being an ex-farm owner, in terms of price of corn, the price of gas, the price of crude oil, those are severely deflating prices in terms of what's happening in GDP and money supply. The price of gas right now is, okay, it's bumped up to near 4, but that's a pretty good peak in the US. But that price this year, too, was first traded in 1990. The average price of crude oil this year is around $78 a barrel. It was first traded in 2007. So these are severe deflationary forces, despite money printing and all that. And the reason is because we can do more of it every day. That's just a macro picture. So I look at gas this year. We've already spiked a little bit, priced for a bit of the risk, which is it typically happens like it does for in April in the grain market. And I think the risk is it does what it did last year and tilts back lower, particularly as you look at the number one engine of natural gas demand has been this country. And we are at the lowest level for demand on an annual basis in 7 years.
Okay, thanks. Bora, I just wanted to go back to you very briefly on fundamentals. Iraqi exports is a headline again that they're back on track, that pipeline is opened. I mean, how much is the market paying attention to extra supply that's been sort of sporadic, that's been held up, Libya, Iraq, etc., Iranian volumes are sort of on and off. Is that influencing where the sentiment, if you like, of where we're going to be?
That's my perception. That's my perception is what's holding back the oil price from taking off, given all the geopolitical instability and the inflationary pressure, is the sense that a lot of supply has been kept off the market and it can come on. But that's what we were expecting from Iran, right, imminently, and it didn't come on. Or obviously, the situation of the world has panned out much more negatively than we expected a few months ago. We thought Biden was going to bring all those barrels on to frustrate OPEC, but alas, it's not happening. But there's the Venezuela situation, and they seem to be rehabilitated, and those barrels will come online. And of course, the news from Iraq that you're mentioning. So there's this perception that the supply will be there. It's available if we need to just turn the spigot on. But I think OPEC's right. The investment is not quite there to the degree that it needs to be. And that may create some unexpected shortfalls. Hence, my outlook for continued volatility.
Okay, there's our survey question. Demand, we kind of discussed that earlier. Demand expectations will be revised upwards for next year, now that the US Fed is likely to pause interest rates next year. I mean, again, that's debatable. We were saying earlier it may have to continue as the inflationary pressures do, but do you agree or disagree that we're actually now going to see more positive demand? I mean, a lot of people have been calling that demand growth next year will be about half to let's say a third or half or less, a bit less than that of this year. Omar, let's just go to jet fuel. What kind of ride is it continuing to have? Obviously, it got a boost in the summer from all that travel that we saw all over the world. Again, what's the outlook for that? Is that momentum going to continue? And are we sort of set to see positive jet going forward?
Look, I think the short answer is yes. Again, it depends on your kind of time frame. I don't know if I'd be buying it now, but I think the kind of answer is yes. I think basically that in an inflationary world, in a world where basically there's a lot of disposable income, where basically there's still a lot of U.S. consumers just fine. You keep seeing all this stuff about, credit card debt and all this, but, spending is still there. Same everywhere I look. So when I travel, get on a plane, the plane's full. Yeah. It's not empty. It's absolutely full. Anything I look at, I mean, when I buy groceries, prices are up. School, up. Flights, up. Everything, up. So I really honestly don't expect this, at some point, yes, it's going to get shot in the head and it's going to keel over. But I don't think it's just yet. I think basically it has, legs to the upside. And I think basically if you look at geopolitics, the war in the Middle East is not going to stop. Is not going to stop. Israel can't stop. The USA can't stop them. It's just going to get worse and worse and worse until something gives. Now, whether that's use of Israel using nuclear weapons in Gaza, I have no idea. But it has to. There will be again a crescendo, and what happens then? Whether you see basically armed conflict, blah blah blah, I don't know. But again, I look at the market. I see winter coming. I see an inflationary market. I see geopolitics. I'm not selling. I don't want to sell. I don't want to sell anything. I don't want to sell the S&P after the turnaround we had. I don't want to sell, commodities. I don't want to sell Bitcoin. I don't want to sell gold. I don't want to sell oil. I want to be long. I want to be long.
Okay. Well, let's ask Mike about those commodities then. Forget about oil, but let's talk about and forget about Bitcoin, but other commodities, gold, etc. Give us your take on the direction for that, given that we are very firmly still in an inflationary space.
So at least let's start with a bullish commodity. That's gold. The average price this year at about $1,931 an ounce in US dollars is the highest ever. And to me, it's just a matter of time that gold breaks out and heads towards 3,000. 2,000 has been resistance for a couple of years now. And every time gold, the per ounce price of gold is at a discount to the S&P 500 for recession, it always just mean reverts towards that level. So I think the meeting place is going to be around 3,000. S&P and gold. Now, if you look at all the other commodities, with the exception of orange juice, which is insignificant, virtually everyone has reverted back to the normal trajectory after a big spike last year. The key thing is that's been the trend in commodities almost forever. And again, the leader, crude oil, is just showing what it always does. It's the most autocorrelated mean reverting commodity. It's one of the worst performing. If you look at industrial metals, they're down almost 12% this year. That's a good indication where crude oil is going to go next year, where the stock markets go. Copper just can't get above $4 a pound. And to me, it's just a matter of time that these interest rate hikes that are just finally stopped, the effects kick in, and all commodities continue to do what they've been doing. You need something unusual, and I wish Omar was right. We could get a rally in the S&P, but I think what's going to happen next year is gold's going to continue to be one of the best performing assets. U.S. long bond market will probably do very well, and I think everything else drops for a normal recession, which we have in our models. Bloomberg Economics is starting by the end of this year, and if you look at the Conference Board's leading indicators, minus about 8%. We've never been that low in leading indicators without a recession. Now it's only 100 years, but that's pretty good, solid. It's just a matter of time. And as far as what I see here in this country, it's just a normal reaction to the biggest pump in liquidity ever that's still going away. And I'll end with this. What Omar mentioned about inflation, U.S. money supply from the end of 2019 increased about 42%. Now it's down to about 33% from that peak. U.S. money supply is running negative. Liquidity is negative. Small cap stocks are declining. So to me, this is just the recession just getting started. You need some kind of surprise. And one thing we do have is election coming up, but we saw what happened for the midterms. You need to let a gas in this country lower and crude oil lower to help the incumbent.
Yeah, well, Biden's dropping in the polls, so he's got to do something about gasoline, I guess, to make sure. Just Mike, and US dollar, what would you say? Oh, there's a 50-50 result. There's something wrong there, but there you go. Yeah, that is where everyone is. Yeah.
The problem with the dollar is it's an unstoppable force. With the US too, it's around 5% in China and Japan and Germany at fractions of that. So the key thing to make the dollar go lower is what's made it gone higher rates. What's going to make rates go down? That's the stock market. Stock market outperforming the world. The U.S. has been completely coincident with the dollar strength. So that's the lose-lose for the U.S. stock market, and the dollar, and risk assets.
Okay, Bora, I'll just let you wrap up with any sentiment you have in terms of, Hormuz Straits Partnership is the name of your company. Give us a bit of an outlook from your point of view on the geopolitical feeling here that we could, you don't know and nobody knows, but would you rule out people now? Everyone's saying, oh, everything's calmed down and we're not going to see this conflict escalate physically, where it would start actually, threatening physical supplies. What's your hearing? What's your sentiment?
I think anything is possible. I would expect, as an armchair geopolitical observer, that this is going to be a long and drawn out torture for the world. Hence, there can be all types of escalatory strategies from both sides to try to knock the other one out, which can spiral emotions out of control, right? So I think we'll continue to have this like war of nerves amongst the capitals. When is it going to end? When are we going to have a ceasefire? When can we move on from this? But I don't think facts on the ground will necessarily facilitate an easy answer.
And what impact is all this having on the Russia-Ukraine war in terms of attention on that? Obviously, the attention's sort of gone off that to an extent, apart from the funding issue in the States. But
Absolutely.
meanwhile, Putin does what he likes, basically.
I mean, the conventional wisdom, the mainstream media narrative has completely pivoted in the past few weeks that Ukraine should give up much of its territory and have a ceasefire with Russia. That's the mainstream media narrative that I'm hearing from CNN, from Time Magazine, etc. That there's no point in one side trying to knock the other one out. Why don't you draw a line through the map? Which wasn't the sentiment a month ago, but now that is the sentiment that's being pushed. And again, I don't know if the belligerents have that view themselves. Maybe they do feel that the other side can be knocked out. So it might continue in a way that doesn't just freeze the status quo, which I think the Biden administration may want that to focus on the Gaza. But in this world, expect the unexpected.
Yeah. Okay, well, thanks very much, gentlemen. We've run out of time. Thank you to Omar, Mike, and Bora for joining me this morning. Have a great day.
Yes.
Thanks very much.
Thank
Bye-bye.
Thank you, gentlemen.